Alright, so this week we're going to be talking about domestic versus international trading and some of the repercussions of that. But first we're going to get going with some quick review of some stuff we've already gone over. Okay, the first thing we're going to review quickly is how we can make money on our stocks passively when we hold them is through dividends. So good dividend stocks are what we call Dividend Aristocrats, and they have strong fundamentals. That's going to be your Porter's Five Forces, your SWOT, just anything to evaluate the company from a very basic level. Obviously, we'd want to look more into that, like what Maggie talked about last week with the balance sheets. We can go even further into the fundamentals with that. And we want to look for a high annual dividend and also a low payout ratio. When we look at the annual dividend, another really important factor we want to take into account is looking at their history with delivering strong dividends and strong dividends on time. A great resource for that is going to be Macro Trends. You can go to their website and just look up kind of their past with that. And so the low payout ratio is important as well, because the low payout ratio indicates that we are focused on investing in our own company and to continue to grow that company from within. So if you find a company with a high annual dividend as well as a low payout ratio, we are in good shape. But going off of that as well, a really great example of one of these dividend aristocrats would be Coca-Cola. They've got a really great returning customer base. They also have a pretty solid annual dividend, and they have a pretty low payout ratio. So yeah, that's an example of that. So now we're going to move on to a second quick review of diversity and the importance of diversifying. We always have to diversify. Diversity can come through our sectors and choice of stock selection. Diversity through reputability, so that's going to be your well-established Microsofts, Googles, Campbell's versus a small startup potentially. And then diversity through regions. And why do we want diversity through regions? As for why we want to diversify via regions as well, is because a lot of changes occur on different levels, right? So you got your international changes like COVID-19 that really affected everyone worldwide. You got regional changes such as natural war or disasters. Think back to even the First World War. That was basically a European dispute for the most part. Obviously, America joined a little bit at the end in some Western countries. However, it was mostly a European issue. Also, there could be natural disasters such as hurricanes through the Caribbean or wildfires in the Amazon rainforest. Those are major disasters that affect large regions beyond just a single nation. And then national changes. So national elections and other domestic disputes obviously have a big impact on our economic climate. And obviously the economy is a big dictator of how our markets are doing as well. So these are why we're going to really want to focus on diversifying our regions beyond just one area. So how do different regions operate? They're generally not that different. They're traded on different exchanges, and they're often categorized differently, which we'll get into in just a second here. So exchanges, what makes them different? So the first one is going to be the location, and then the types of stocks, as well as the rules of the exchange and the governing body. So the New York Stock Exchange and the NASDAQ are both North Americans. Obviously New York is New York, and then you got London Stock Exchange, Tokyo Stock Exchange, Shanghai, Euronext, and so on and so forth. And the big thing to keep in mind here is that while they all operate under slightly different rules, they all are structured with the intention of protecting the consumer, of the buyer of the stocks. Some of these are known for holding more staple companies such as Microsoft or Apple, Google, all those type of kind of tycoons. So that's going to be an example of some of the larger stocks that I'm talking about, versus some exchanges are more known for smaller stocks and smaller companies as a whole. And then the location. So obviously NASDAQ and New York Stock Exchange are going to be primarily U.S. companies and North American companies. However, they are actually very international in their origins. But if you look at more like Shenzhen or Hong Kong, they're definitely going to be much, much more focused on China and Asian products and Asian companies. Apologies. So how does this connect to our case study? Florian is interested in diversifying his portfolio beyond the US. This is an excerpt taken directly from the case study. It says, in addition to his entrepreneurial endeavors, Florian is an active angel investor, having invested in more than 80 companies globally. In Brazil, he is an investment partner in Canary, the leading seed stage investment firm in the region. Canary has more than 150 million in assets under management and has invested in more than 60 companies since its inception in 2017. Angel investor is synonymous with someone who is a private investor with a very high net worth. So we can invest in international stocks in our competition, as I'd hope you're aware of by now. The 4 regions that we're able to invest in are North America, Latin America, European, and Asian. And the Asian market is actually a little bit interesting for us. There's 4 options: Mumbai, Hong Kong, Shanghai, and Shenzhen. And these 2 are mainland China. Well, actually all 3 of these are. But Shanghai and Shenzhen are actually kind of absorbing a portion of Hong Kong, and they're kind of being assimilated into that. So I'm not sure how that's going to change in the coming years, but bottom line is if you buy through Hong Kong, it's probably not going to change a whole lot. And Mumbai is India. So that's something to note. So first we're going to start with our North American region. We're going to talk about that a little bit. So there's a number of exchanges in North America. The biggest ones by far are the New York Stock Exchange and the NASDAQ. But for our competition, they kind of just group them together and say United States. And then the other option is going to be your Toronto Stock Exchange. We're probably the most familiar with North American stocks and trading through the NASDAQ and New York Stock Exchange. That's regulated by the SEC, and yeah, overall it's just it's pretty liquid in general, so it's pretty solid if you're going to try to trade through there. I think I just... No, okay, I didn't skip any slides. Okay, the second one we're going to look at is the London Stock Exchange, which is here. London Stock Exchange is the hub for European stocks, and it's the only option they give us for our competition. It functions very similar to the NASDAQ or the North American exchanges. However, they have even more strict rules regarding which stocks they list, and they're a very reputable group as a whole. They actually have been really focused on becoming more international in their selection for stocks that they list, because they're so reputable and because they're so strict. Consumers generally respect it as a whole, and because they respect it so much, the companies also want to flock. They flock to that because they want to be known as reputable as well by association with the London Stock Exchange. And then we've also got the Asian Stock Exchange, which is broken down into a few different parts. So we've got Shanghai and Shenzhen, and as well as Hong Kong. China's economy is the second biggest economy in the world. However, that's not really reflected in their stock market. So China has grown 30-fold in the last 27 years. However, their stock market has not reflected this, as I just said. If you were in the stock market 27 years ago, and you put $1 million into the Chinese stock market, you would have less money today than you did then. This is due to the fact that they're focused on reinvesting rather than sharing dividends. The domestic Chinese stock is owned by a small portion of Chinese individuals, because only roughly 7% of Chinese people own stocks. Well, Chinese people in China. However, these people do have a lot of money, which is very beneficial. Another thing to take note of is their political regime in China, having a big impact on their overall economy as a whole through central planning, and also owning a large portion of their nation's big companies, which, with the exception of a few very large ones such as Baidu and Alibaba. So that's an important thing to keep in mind. So I have a quick thing here to explain Brazil's exchange. Brazil's exchange is known as the B3. Some companies listed on the B3 have two options as ON or PN. So ON means ordinary, and that means they have voting rights. And then PN means preferred non-voting, and that means they get a higher share of dividends, and they also have the first pick of dividends, or they're the first priority when getting dividends. So 3 is going to be ON, and then 4 is going to be PN. So PETR3 is going to be an ON, whereas PETR4 is going to be a PN. So that's Petrobras, which is the company that I'm talking about here. Another thing to take note of, which one would Florian probably prefer? I know we're only investing $10,000, or well, we have a $100,000 portfolio to work with now, but assuming we would win the competition, he would be probably a pretty big contributor into whatever company he's interested in Brazil, especially if it's a smaller startup. That's something to take note of. So the Brazilian Stock Exchange is also known as the B3. Brazil's economy is extremely dependent on their politics, which has been extremely volatile in the last number of years. However, it is an emerging market, which is always a good sign for investors. They're currently stuck in what we know in the economics world as the middle income trap, which is when they basically exploited their low income individuals to an extent where they don't really have a whole lot of low income individuals to exploit anymore, which is a problem for them. Also, their geography makes it very, very hard for them to kind of connect their nation, because the Amazon rainforest is not only protected by the nation, but it's also internationally protected. So basically they function as a large number of smaller countries, basically within a bigger country. Their cities are basically countries in themselves. Also, it's very hard for them to export due to the fact that they have they have mountainous coastlines, which makes things somewhat problematic for them. Their new government has made economic growth a top priority for them, so it seems inevitable that they'll do better as time goes on. Okay, so let's just quickly wrap this up. So the things to keep in mind: diversify your stocks by location, super important. Keep in mind what index you're using, because you need to know what rules kind of govern that. I know I didn't go into that today, but there's only so long I can make these videos, and I don't want to bore you going through all the rules. And finally, view your stocks through a broader political and economic lens. That's super, super important. Economics and finance are so intertwined, and to view only the company without looking at the environment surrounding it would just be completely foolish. And then finally, we'll go on to the discussion questions. These are things you're going to want to talk about with your group on whenever you meet. How is the broader economy looking in the face of the COVID-19? Which regions will be more heavily impacted than others under various events? These could be natural disasters, political instability, COVID, and why? And finally, how will better understanding this potentially change your strategy? Better understanding how the regions will be impacted under various effects. How will you manage your risk in that scenario? All right, so that's it for me this week, and yeah, have a good one, guys.